Federal Reserve interest rate decision, investors on edge amid global uncertainty. As the Federal Open Market Committee, FOMC, prepares for its next meeting, investors worldwide are watching anxiously. The Federal Reserve's interest rate decision is one of the most significant events in the financial world, influencing everything from stock market performance to mortgage rates and economic growth. With recent market volatility and growing uncertainty about global economic conditions, the stakes are higher than ever. Why investors are nervous. The Federal Reserve controls short-term interest rates, which affect borrowing costs for businesses and consumers. Lower interest rates typically boost the economy by making loans cheaper, while higher rates slow economic activity to curb inflation. However, in the current economic environment, the Fed is facing a tricky balancing act. Over the past year, inflation has cooled significantly from its peak, but it remains above the Fed's 2% target. At the same time, economic growth has been stronger than expected, and the job market remains resilient. These factors suggest that the Fed could justify keeping rates higher for longer. However, Wall Street investors have been hoping for rate cuts, which would make stocks more attractive by reducing borrowing costs for companies. Recent declines in tech stocks, driven by concerns about higher for longer interest rates, have only added to investor anxiety. Many analysts believe that if the Fed decides to keep rates steady or signals fewer rate cuts than expected, markets could react negatively. The global uncertainty factor. Beyond U.S. economic conditions, global factors are also at play. Geopolitical tensions, including ongoing conflicts and trade disputes, have created additional uncertainty for investors. For example, supply chain disruptions due to international conflicts have raised concerns about inflation rebounding. Additionally, central banks around the world are making their own interest rate decisions. If the European Central Bank or Bank of Japan take a different approach from the Federal Reserve, it could impact global currency markets and investor confidence. What the Fed's decision could mean for you. For the average person, the Fed's interest rate decision has real-world consequences. If the Fed keeps rates higher for longer, mortgage rates may stay elevated, making home buying less affordable. Credit card and loan interest rates will remain high, increasing costs for borrowers. Stock markets could see more volatility, affecting retirement savings and investments. On the flip side, if the Fed signals rate cuts are coming soon, borrowing costs could decrease, potentially boosting economic growth and making stocks more attractive. Expert predictions and market reactions. Most economists believe the Fed will keep rates steady at this meeting, but the key factor will be what Fed Chair Jerome Powell says about future cuts. If he signals a cautious approach, markets could fall as investors adjust their expectations. However, if he hints that rate cuts are coming later in the year, stocks could rally. Investors will also analyze the Fed's updated economic projections, known as the dot plot, which shows where policymakers expect interest rates to be in the future. If it suggests fewer rate cuts than markets anticipate, stocks could react negatively. Final thoughts. The Federal Reserve's decision is more than just a technical economic move. It's a signal about the future direction of the U.S. and global economy. With so much at stake, investors, businesses, and everyday consumers are watching closely. Whether the Fed holds, raises, or cuts rates, the effects will ripple through financial markets and impact millions of people worldwide.